We are officially live on the edition of the Dr. Average Adventure Show, the JWB Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody.
Can you smell the Red Bull in my breath and feel my energy?
You went strong on the Red Bull for this.
And with us, as always, is our phenomenal community manager. We call her MTM because she tends to bring us the moments that matter, and because we call her Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And we still promoting the class, GC?
We
Of course
surely
we're promoting the class, because until July 4th, you can get $500 off on our class, How to Invest in Rental Income Properties the Smart Way. And you can get that at notyouraverageguide.com. And you hit the promo code. You like to give good news. What's the promo code?
The promo code is SAVE500.
Save 500. GC and I put a lot of love into catching everybody up, right? Like now that we've been doing this show for 3 years, we've explained all these concepts. We have a thriving community. Everybody's throwing all these big terms around. If you want to catch up to the terms, if you want to just go from 0 to 60 on how to invest passively in rental income properties, set yourself up for success long-term, no matter who is selling you the property, no matter who you're dealing with. You want to take this class so that nobody can pull one over on you, right?
Yeah. And I think if you have ever wanted to talk to somebody who's built a portfolio of over 300 properties, it's probably pretty valuable. What if they just kind of like shared all of their thoughts and their experience and their expertise with you, right? If you ever wanted to go to lunch with somebody, like a 2-hour lunch with somebody, and just like, man, what have you learned in your journey of building a portfolio of over 300 rental properties? This is your opportunity to do that.
It's true. It took me 3 years to get him to do that lunch with me.
That's true.
And then about 2 months to get that lunch on tape. So it's a good time. It's a good time. Broken down into like 6 to 10 minute segments. It's about 2 hours total. You're going to be a pro. It's got all the cheat sheets and everything that you're going to need. So go to notyouraverageguide.com, put in save 500, get $500 off the class. And then when you get to dial into the call, you don't have to think about what you don't know. You just get to be part of the fun stuff like what you see.
The roll call.
The roll call, baby. We got Lee Bishop, the MVP of the community, in the house, checking in first.
What do you know?
What do you know?
Stealing the show from the leadoff batter.
The leadoff batter, John Henning, who's checking in second. Big Papa's in the house. We love it when he calls him Big Papa.
What a fixture. Pops, what's going on, buddy? Good to see you.
I love that. I love that he showed up so often these days.
You know what? He's a great case study just for this community because, my dad and I talk all the time. He knows what's going on. He invests with us, all of this, because I've been around this business for 17 years like we have. But probably about 3-4 months ago, I said, hey, Dad, I think I want you to check out this show because I want to get your feedback on this one. He checked out that one show and has made every single show since then. And it's not like I'm forcing him to come up. It's because of you guys, right? It loves this community. And so we appreciate Big Papa being in the house, and we appreciate all of you for making it so cool for him to be here.
Love it. We got Leo Furbaganan.
Dun, dun, dun,
Furbaganan.
dun, 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 dun.
Good morning from the Bay Area, California. We got Sir Jeff Bolton in the house. Good morning, everyone from Yosemite.
Yosemite, love that.
Man, one of my favorite places in the world. We got the ringmaster in the house.
Andrew Barnhill.
We got Layla Powell is back.
JWB teammate. Let's not mess that one up.
Again.
I've messed that up. You've messed that up.
Yeah, Layla, love having you here.
Awesome to have you here.
Yeah, definitely. We got the fairy godmother in the house from Monterey, California.
Miss Jen Filson.
Miss Jen Filson. We got the early bird in the house from Columbus, Ohio.
Mr. Dean Curry.
We got our favorite Pacific Northwesterner in the house.
With his trademark.
Good
Good morning, good afternoon. JWB family. Hope you're doing well. That is none other than Nadine Shaw.
We got the mountain man.
Billy Green.
Billy Green from the mountains of Colorado in the house. Who else we got in here? We got our regulars, Rosalind and Gary Riley from Murrieta, California.
We regard you.
Yes, we got it.
We nailed it.
We got Ali Abdullah in the house. Ali, I feel like has been starting.
Love that, Ali. Very, very nice to have you here.
Good to have you, Ali. Who else we got? We got Victor Scarpula in the house from Queens, New York. Victor, good to have you back as well.
That.
Happy to have you. What else we got in here? Just scrolling through. We got the first family in the house, the patriarch and the matriarch, Ken and Carolyn Moline. We salute you over there in Silicon Valley. Good to have you. We got Mark Mills back in the house saying hello, all.
Hey, Mark.
Good to have you, Mark. We got Mark Norman. We got Mark and Mark in the house.
Mark and Mark.
Mark and Mark.
Good morning.
Good morning, all. We got the man that everybody knows us from California.
Noah
Randari. Good to have you. Who else we got in here? Andy Norris from a hazy Columbus. Andy,
new name. Welcome
Andy.
to the party, Andy.
Welcome to the party, Andy. Good to have you. Hope you make it a habit.
Saw a little Denny Davies action there.
We got a Denny Davis.
You can welcome.
Suey, Danny Davis. Good to have you, Denny. Great having you back stateside, man, even if it's in Arkansas. We got Bill Shields in the house with a, did he check with a?
I'm sure.
Feliz Dia de la Propiedad, amigos. Good to have you, Bill Shields. We got the maven, the real estate maven from the mountains of Colorado.
Leslie Wilson.
Leslie Wilson, happy to have her in the house. And the karaoke witness,
Deborah Schwartz.
Deborah, always great to have you. BJ McKay checking in from Star Valley, Wyoming.
All right, BJ, great to see you again.
Sounds beautiful, man.
Becoming a regular.
Yeah, man. Kathleen Lubin also checking in from California.
Right.
Mahesh Pagaku, a couple of our newer community members, starting to make a little ritual out of it. We love it. We got Pamela Myers from the Seattle area. That's a new name, is it? No?
Pamela, let me know if you're a client yet. I believe Pam's a client, and I believe I haven't talked to Pam in a long time. So I'm hoping it's Pam, regardless if it's Pam who's the client or not. It's great to see you. But
Happy
Pam,
to have you on the show.
let me know if you're the client, Pam Myers.
All right, cool. Let's get it started with my favorite segment right after the roll call. When Madison shares good news. What's the good news, Madison?
All right, everybody. I haven't shared this news in a while, but to give you a little bit of backstory, almost every month, at the end of the month, we open our offices to some JWB clients. So anybody who's interested, first of all, don't just show up, please reach out to, we would love to have you here, but reach out to your portfolio manager first to get the details of dates and all availability. But tomorrow we get to host 3 clients that I have never met before. So I'm super excited. They get to talk to the team, meet the team, have lunch with us, just go see their properties, just get to hang out with us all day, which is always super cool experience. The 3 clients we have coming, Michael and his wife own 10 properties. They are in the medical field, started investing with us in 2019. Super excited for him to come. The next 2 are actually PMC clients. So they brought their properties to us to manage. And that's super exciting because they get to kind of see how we work behind the scenes, talk to sales, talk about their experiences buying a property outside of us, and then kind of how we could help them grow that portfolio. So we have Bradley, who brought his first home to us in 2022. And then we have Raquel and her husband, who recently moved from California and are now Florida residents. And they own 2 properties with us. So super excited to have these guys in the office tomorrow.
Fantastic. It's nothing like the ability to meet the folks that you get to be a big part of their financial portfolio, the folks that put so much trust in our team. The ability in today's day and age to shake their hand, give them a hug, and get to meet them personally is an incredible opportunity. So we're super excited to see all of them.
Love it. Love it. Madison, that's good news. Thanks for sharing, buddy. All right. So as we get started here, I want to update. I totally missed Tammy Gamison from Colorado Springs checking in with a team game time. Whoop, whoop. I'm always a fan of anybody that shows up with their nickname.
Love this.
New name in the show. Already nickname Tammy Game Time Gamison.
Oh, man,
I'm all in.
Perfect, Tammy. It's great to have you here. Thank you. Thank you for being here.
I appreciate you checking in. And Pamela Myers just bought her first JWB property. So
all right. Fantastic.
Cool.
There we go.
Yeah.
Congratulations, Pam.
Love it. So as we go here to the property, we got some breaking news. You said you had some breaking news?
Did not see that coming. We do have some breaking news. This is really amazing news for the city of Jacksonville. We have a brand new mayor, and it's not just any new mayor here in Jacksonville, but our very first female mayor in Jacksonville's history will be taking her oath to become mayor this Saturday. So super excited. This is Donna Deegan, who was just elected mayor, and she's just a wonderful leader. We're really excited about her leadership. She's very big on transparency and bringing everybody together to be a part of the conversation. And so we're super excited for her leadership. She outlined a few things that are really top of mind for her office and for Jacksonville overall. And a lot of these actually are things that we've talked about on the show. So I thought it would be a pretty cool kind of an update here. The most important thing that is on the minds of Jacksonvillians, this Jacksonville Jaguars stadium deal. It's in the news. We did a show on it. It was one of our highest attended shows.
It's the podcast I published on Monday. So if you want to check it out on the podcast, great show.
Yep. If you want to find the podcast, just go to wherever you get podcasts, search Not Your Average Investor Show.
Yep.
Fantastic opportunity to highlight not just the Jacksonville Jaguars stadium, but beyond the stadium, what is being pitched here. And it's talking about Jacksonville arriving on the scene. And the stadium deal is one part of what is going on already in Jacksonville, which is downtown Jacksonville is becoming revitalized. It is making a big impact. And this stadium deal will really, really make a big impact. So the negotiations for the stadium between the city, Donna and her administration and the city council and everybody, the stadium negotiations between them and the Jags can start as early as next month, according to our mayor to be.
Nice.
She said that she's going to take an approach where she's going to include a lot of people to make sure that this is the right deal for the city.
Smart.
She said she's going to break down the teams that are going to evaluate this on behalf of the city into 3 areas. She's going to have a financial team made up of her top staff. She's going to have a team of city lawyers to look over the deal. Always a good idea. And then she's also bringing in outside negotiators that know how to deal with the NFL, which I think is great.
It's great.
Right? We want to make sure this is a win for the city. We want to make sure this is a win for the Jags. And I think there's a lot of opportunity to do that. All of this is in anticipation. Both sides have come forward and said, we would like to reach an agreement no later than the second quarter of 2024. Okay. So it's June, July-ish timeframe here in 2023. So this is going to be a topic that we're going to talk a lot about. And the goal from both sides is to do that in the beginning of to middle of 2024 so that construction could start as early as 2026 on this new $1.4 billion renovation.
Nice, man. I love the fact that we're going to be able to continue talking about the stadium deal, right? Like, I think that what my biggest takeaway from the episode about the stadium that's on the podcast right now is just how similar the things that they are talking about when it comes to that stadium deal sound to all the stuff that we talk about on this show, right? Like, it sounds like my big takeaway was when you're like, you can take stadium out and insert JWB downtown development, or you can take downtown development out, insert UF campus, you know, like all these different things that are colliding with turning downtown into a true center of a city that is a 24/7 live, work, play, and the value that that creates as a flywheel for the entire city is just a fascinating storyline for me. And I'm glad that Mayor Deegan's going away the way she's doing it, because there's a lot on the line here.
Mm-hmm.
I've been a part of cities that get screwed over by
Mm-hmm.
professional franchise, you know, it's like that are holding them to the fire. So I think that's a really, really smart approach. And I love the through line that's going through all of this, man. I'm pumped
And
to
it's
talk about
more
it.
than just the stadium deal. The Jags and the city would like this to be a part of a bigger vision of that downtown revitalization, that continued revitalization of downtown. So this can be a $2 billion deal.
Yeah.
So when you're talking about billions of dollars,
Yeah.
price, it makes sense to bring in some people that have negotiated before.
Yeah.
And so I think it's a really smart move. And then just, you know, talking about what is going on downtown, even before this $1.3 billion renovation that we're talking about here, there's already $4 billion worth of construction going on in downtown Jacksonville now. That is up from 700 million just 5 years ago. 4 billion's going on right now. So it's happening whether or not this stadium renovation happens, which I expect it will happen, but like,
Does that
it's not dependent on that.
Is that 1.2 billion number included in your $4 billion figure?
No,
Yeah, okay.
no,
All right.
it's not. So this is 4 billion that's happening right now. The Jag Stadium's 1.3 to 1.4 billion. You know, there are not many downtowns around that have this many billions of dollars of activity going on. And if you want to take advantage of that, the best place to do it from a risk mitigation perspective is to invest in single family rental properties, much like the one I'm going to be sharing with you today, in neighborhoods that are surrounding downtown. That is how this entire strategy, this JWB strategy, comes together. And that's what I want to share with you, because you can take advantage of this Jag Stadium. You can take advantage of this $4 billion in construction. You can see rents and home prices go up when you invest in those risk mitigated neighborhoods.
Yeah. And to catch anybody up that hasn't been with us for the last 2 years, as we're talking about all of this, the idea is we've seen this pattern before. We've seen downtowns come alive in Nashville, in Charlotte, in Denver, in Austin, all these different places where the single family homes around the urban center go from being these very affordable things that people, yeah, do I want to live there? Do I not? Do I want to invest or do I not? To this like very desired place, and you know, property values, the curve of appreciation just bends, right? Like it bends upwards and it starts appreciating rapidly. So the idea of getting in before that happens, it's like buying Apple stock before they announce the iPhone or something like that, and having that inside track. And the reason why we're so bullish on the rental properties as opposed to investing in the downtown itself and condo developments or whatever's happening in downtown is because the future of downtown is very bright, but the present of the stuff that's going in there right now does not create that positive cash flowing equation in the short run for the average investor to be able to withhold it. The people that are investing in downtown have bigger purses and can wait for it longer, and therefore are in a different kind of like table at the Bellagio, right? Like they're like at the $500 table. We can be investing in the single family homes at the $5 table. That doesn't exist in the Bellagio, just FYI. But yeah, it's a more risk mitigated game to be in positive cash flow from day one in these workforce housing, single family homes that have proven themselves to be incredibly resilient across everything. And yet they will still benefit from this idea of the urban center coming around. So that's why we talk about it a lot on the show. All right. So we got a couple of questions regarding that. Lee Bishop, he's the MVP of the community. You may have
Heard of him before?
Yeah, you may have heard of him. He says, hopefully JWB will continue to be on some form of leadership with the new city development team with the new mayor. Is Alex still in place? Can you explain what he means by that?
Alex Afakis is my business partner. He's our president. Absolutely. A big part of his role is to be outside of JWB, outside of our offices, so that he has those relationships with key city leaders. He's pretty influential in Jacksonville, and that is going to continue to be a big part of his role. That's how he creates many opportunities down the line, which become turnkey investment opportunities for you all. So that's not changing. He has a great relationship with Donna and her staff, and we're continuing to, invest in those types of relationships.
So if you're new to the show and you haven't heard of the Tasmanian devil of Jacksonville real estate development, Alex Afakis, who is Gregg's best friend from college and business partner, co-founder.
High school.
Oh, from high school.
Yeah.
Okay.
Well, maybe we weren't best friends in high school. I can't tell you that.
Anyways, what I find fascinating is that this is all deliberate, right? Like when you told me the story of Alex coming to the three other partners and saying, hey guys, 10 years ago, hey guys, Jacksonville's downtown is going to be a thing. So my plan is I want to go out there and build all these relationships and help as many people as possible in the city. And I want JWB to back me up on this thing because in like 10 years or so, this thing's going to pay off with a straight face. And you guys said, okay.
Yeah. Yeah.
It's fascinating.
When you think about highly speculative investments, that was probably the highest level of speculation I've ever done with an investment.
Yeah.
But you know what? It pays off.
It pays off.
Those types of opportunities that we have and that our clients have as a result of the relationships that Alex has built over 10 years, 15 years, there's very few people that are as influential as he is, and we all get to benefit from that.
And the reason why that's important as a real estate investor is because we harp on this idea of vertical integration. Right. And this idea that you can go to turnkey providers that can like find you a property and a property manager is one thing, but then there is vertically integrated providers that can, have bought the land, are building the property themselves, are the property management team, are the portfolio management team. And then the next level up is working with the city to develop the macroeconomic circumstances to increase average incomes, median incomes. And that is one of these like beautiful alignments that doesn't happen in a lot of places. And Alex is that extra nugget that is doing that thing outside of the property line that adds value to all the pieces all together. And it creates a real win-win alignment of all stakeholders. Right?
100%. He's our innovation department.
He is your innovation department. And by the way, relationships, compounding asset.
Yeah.
Right.
Yeah. 100%.
So I see it very, very much in line with the ways that you guys think. Jen Filson, the fairy godmother, you may have heard of her.
I have.
She asked, when are you guys going to bring Mayor Donna on the Not Your Average Investor Show? Greg?
It's a great question. I can tell you in her list of priorities in running the city right now, it's, installing her staff. She's got a budget to present. She's got to work on the Jag Stadium renovations. I'm pretty sure right below that is getting on the Not Your Average Investor show. Number four list of priorities. Oh, God. She's got to check up a couple of things. We'll see what we can do. We'll see what we can do.
We'll be working on it. We got a regular guest here all the way from France. Anonymous Attendee.
Oh, fantastic. Nice to see you, Anonymous.
Asks, would you manage a multifamily?
Would we manage a multifamily? Yes, absolutely.
Okay, cool.
Right. It's actually a niche that I think we serve very, very well, because as you start to get into multifamily units that are a little bit larger, think 8 units, all the way up to small apartment complexes, think like 8 to maybe 80 units. You fall into this kind of abyss where you don't really know which property management team can serve you. You're kind of a little bit too big for the small mom and pop property management companies, they don't really know how to serve maybe a 10 unit or a 20 unit small apartment complex, but you're too little for the big management, commercial management firms. JWB plays really well. We manage those. We of course manage single family. We manage regular multifamily, think 1 to 4 units, but I found a niche that we really serve an underserved community of bigger multifamily, smaller apartment complexes as well.
Got it. And then the follow-up question is, would you sell multifamily to us?
We do not sell multifamily generally, and they're not because we don't love multifamily. It's just most important to put you in the right neighborhood for continued success in this model. The neighborhoods in Jacksonville, there's 4 of them that we're going to put you in. One of those is what we're going to talk about here today on the property of the week. But those neighborhoods are largely built out with single family homes. There's just not a lot of multifamily inventory there. So while I love the concept of multifamily and generally it can work, and especially in other parts of the country, it is more important to put you in the right neighborhoods in Jacksonville, and just simply there's not a lot of inventory there.
Yeah. And, and they're also asking, would you help them find a multifamily? I think the most important question I hear when people are talking about multifamily is, why do you want a multifamily?
Yeah.
Right. It's like they're generally saying, well, I get four different rents for one asset class. And how could you speak to that, GC?
Yeah, it's a great question, asking why. A lot of times you can accomplish those same things, those economies of scale, right? The ability to have 4 sources of rent coming in if one doesn't pay or if one roof goes out, right? You can accomplish those same types of things in the single family portfolio that JWB can create for you. And what people don't realize is on the multifamily side, there's a lot more variables when it comes to actually putting the deal together. A lot of this comes down to the financing. It's not nearly as cut and dry and as simple. On a single family home, it's very easy to understand within a small range what your property is going to appraise for. And that's because largely there's a ton of single family homes that have sold right around you. But especially in the types of neighborhoods that you want to be, workforce housing neighborhoods in Jacksonville, I already kind of shared with you, there's not a whole lot of inventory there of multifamily properties. Well, you can't take other single family properties and use them as comparables to multifamily properties. So appraisers have a much tougher job when it comes to appraising multifamily properties. The way this lands on you as an investor is if you put a multifamily property under contract, the appraiser has a tough job because there aren't a lot of comps out there. They come back with a lower value than the contract price. It appraises under. That means you're stuck with the decision of either to bring more money to the table to close or to not do the deal. And those aren't good positions to be in. So a lot more variability when it comes to multifamily. And again, you can accomplish a lot of what you want in a single family portfolio with a vertically integrated provider. And so if you have those types of questions, that's a great question. When I see that one, that is a great time to jump on the phone with my team and talk through why. What are we trying to accomplish? And see if a single family portfolio can accomplish that for you. And you do that by going to
chatwithjwb.com.
So in line.
If I was to summarize what you were saying, you have one of the biggest property management companies in the United States, definitely in Florida. So you are able to handle the property management of a multifamily. If somebody finds a deal, it is not within your business model to help people find those deals because you are focused on the single family home, vertically integrated, providing those homes. And you can provide the same conditions of generally the same whys of why you would want multifamily within that business model. So whether you're looking at having a multifamily yourself and finding it yourself, or maybe you're curious about okay, well, maybe I do want to just go, vertically integrated with JWB and not have to worry about all these different things. You go to chatwithjwb.com, you can clear all that stuff up and it'll be a good use of your time. Is that kind of what you're saying?
There you go. And if anybody's interested in just regular management as well, you can go to either chatwithjwb.com, or there's a special tool that we help you analyze what your property would rent for if you're thinking about bringing that management to us. That's at jwbpropertymanagement.com. We'll actually share with you what the rental comps are for the 5,600 homes that we manage so that you can know what we could rent your home for as well.
Sweet. All right, GC, we're almost a half an hour in. We got 76 people on with us today on the POTW.
Amazing.
I love it. It's been a minute since we show a property. So let's get to it. I'm going to magically whisk ourselves away here to 8455 Jasper Avenue, Jacksonville, Florida. 32211. It's got a purchase price of $245,000. It's got a monthly rent of $1,588, 4-bedroom, 2-bathroom, 1,490 square feet. It is ready to go. Construction status finished. It's got the average duration of resident stay through JWB Property Management of 4.5 years. This best-in-class appreciation rate that we all love about Jacksonville, cash flowing market with a best-in-class appreciation rate of 4.6%. But the most important number, what not your average investors look for, is this IRR here that is beating just about any other investment that you can get in at this kind of level of risk profile of 12.9%. But GC, what do you love about this property?
Thought you'd never ask. Well, I'm going to start with the most important thing, which is the last thing you said. Looking at an asset that is risk mitigated, that you do not have to take outsized risk. You do not have to speculate. Looking at an asset that produces almost a 13% return on your money each and every year is really hard to find in this economy right now. So I love the IRR on this, like I love the IRR on all the properties I bring to you, right? If you see that roughly around, call it that 11%, 12%, sometimes creeping up a little bit higher IRR, and that's what we have here. Beyond that, I love the neighborhood that this home is in.
Oh, tell me more.
There are 4 neighborhoods that we are going to put your assets in. There are 4 neighborhoods in Jacksonville that we focus on. One is called the North Side. One is called the West Side. One is called Arlington, and one is called South Side. Oh my goodness. North Side, West Side, Arlington, and South Side. And all 4 of those neighborhoods, I love the same. They're like my kids. I love them all, right? I love them all the same. But this one is really in particular here. I wanted to point out this one is pretty cool because if you think about the birthplace of that build to rent phenomenon, which is a phenomenon now, we started to do build to rent in 2011, was this neighborhood that I'm showing you here on Jasper Avenue. So that we're live there on the map there.
We're live there on the map. So you see?
So what you're going to see here are all of these blue dots of homes that JWB has either built or renovated and sold to clients and is currently managing. So if you have that question, if you're an out-of-state investor and you're like, how does JWB really know what my home is going to rent for? When you look at a map like this and you see the amount of activity that we have in the city, 5,600 plus homes that we manage, and then you zoom in to see the property that you would be buying, and you see this many homes that we manage in a mile radius, that answer should become very clear, right? It is about the volume of activity we do in a small place, which makes more of a positive impact for our community and reduces risk for you and allows us to run our business better. And I don't know if there's a better example of that than Jasper Avenue.
Love it. And we talk a lot about this data flywheel. Shout out to Tara. And the reason why it's really important. So what we talk a lot about on the show about is, number one, the economies of scale at which you're able to operate when you have that much density. I zoomed in and out so that everybody could see all the different properties all around Jacksonville, right? That's a giant population cluster. And then as you zoomed into the actual neighborhood, it was one of the more dense areas of things like that. The lime green arrow did not show up until like multiple zoom-ins because there was so many all compiled into each other. What that essentially means as an investor for me is that there's generally going to be a maintenance person or somebody that has to do with JWB somewhere around that area without necessarily needing to be at my home. And that's just more eyes, more capacity, more purchasing power, right? Like your contractors know the area because they're around there. Your contractors know that you are feeding them all these different points of data, and therefore you get the best prices, you get the best service. You're the 8,000-pound gorilla because you spend $7 million a month in construction costs, right? 7 million, is that right?
No, it's not right, but
Numbers.
probably like four.
I'm not the
but,
numbers guy.
I think people know by this point that they just, you're just a few numbers off every time. So I think they're okay with it.
Yeah. So that's one thing, right? This like economies of scale, operational capacity. The other thing is the data flywheel, right? The idea that there's these 5,000 data points. That's a number that I feel pretty good about that are always feeding these deal evaluations, right? Like when we put the course together, we talked about the data that goes into it and how to trust it. And there was just kind of like multiple levels of how much you can trust it. The average turnkey rental property person is taking it from a book, right? Like they're just like, oh, okay, well, I took this education course and now I'm doing this thing. And this is what I should put here for maintenance expense and for vacancy rate. The slightly better rental property person is doing it based on market comparables. They're like making some calls and they're finding out the market area. The really, really professional property manager that does this for a living and operates like a Fortune 500 company or a Silicon Valley company that has a data flywheel is taking proprietary data of other homes that are like yours in the same area with the same type of resident profile, with the same type of like maintenance profile and same price points and whatnot, and are giving you a real historical average number that has been really teased out. And that to me is the most attractive part of having these many, many, many data points all clustered together.
Excuse me, you nailed it, brother.
Well, thanks, buddy. Today, Junior. All right. So cool. Anything else that you wanted to talk about in the love about this property? Or are we freestyling for the rest of this episode?
Freestyle, baby.
Freestyle. Let's go. All right. So Jack Chatta, Milady Jag, welcome to the show. Good to have you back. Just checking in, asking, when is the next property tour?
That's 2 questions in the last 2 shows about, are we talking about the property tour or the Not Your Average Investor tour?
The property tour, I believe she said.
The property tour. So like a client tour is, I'm sure, what she's asking. So we generally do that every month or 2, really depends on client demand. So if you'd like to, come down and visit, reach out to your portfolio manager. We kind of cluster all that activity together, find a good time for everybody, and then we plan one. So it's largely dependent on you all.
Got it. MVP Lee, Jen is already pumping it up. Q1 2024, another big JWB meetup here in person.
Yes.
Chances are yes.
Yes.
Yeah.
We got to nail a date down. We'll probably do that in a month or 2.
All right. So, in a month or 2. I love it. Yeah. Okay. MVP Lee is asking, this is a brick front, which is one of the JWB original designs. Look at this guy. He's a historian in JWB homes. Is this one of Gregg's original portfolio? Man, a lot of historical knowledge.
JWB historian.
Yeah.
I love that.
That's cool.
I love that. No, this was not a home that I owned. This was one that was owned by a prior investor. We purchased that home and then we renovated it and now we're selling it.
You want to give a little backstory of all the assumptions that were in Lee's historical question there?
Just knowing, you mean as far as like why you would assume it was in my portfolio?
Yeah. So I think the things that were behind this question is the idea that you guys own 300 properties yourselves, right? So like the business partners of JWB own 300 properties, all clustered in the same area where we all invest as well.
Yes.
That is another strategic alignment, right?
Yes.
Like you are buying from somebody that does this themselves. And then second is there was original brick front designs. You guys were doing that at some point?
It's great that he knows that. So so when I talked about this being the birthplace of build to rent, when we started to build homes right around Jasper Avenue, I think there were 40 or 45 homes that we built right there in Oakwood Villas, which is another name for the Arlington neighborhood that we're in. A lot of those first builds had brick facades. So Lee knows more about JWB than most. And so it was a good idea that it might've been one of the original homes that we built, but this home was built in 2009 and we started our build to rent in 2011. So this was not an original, but probably next door to an original.
And when you started urban infill build to rent was when urban infill build to rent started, right? Like that is one of the big superstars of your Alex Safakis innovation program. This idea of
great idea,
bringing a new asset to market in a new delivery method that made sense for investors and it made sense for JWB. And that's why you've been written about in the front page of the Wall Street Journal at least once.
New construction is a huge win that our innovation department hasn't been able to do and now has caught on. And there's billions of dollars in this space from Wall Street. They were just about a decade behind us, which is kind of cool. Townhomes, right? We sell townhomes, right? We brought townhomes into this asset class as far as turnkey rental properties and have sold hundreds, if not thousands of them to clients. Another super successful thing that was brought on by our innovation department. How about when we built the Jacksonville's first shipping container apartment complex?
That's right.
We did that, right? That was an opportunity for us to see if we could reduce build costs for all of you. Now, that one didn't exactly work out on reducing build costs. Still a super successful investment and wonderful for downtown and wonderful for our portfolio. Got a lot of PR on that. And then, other examples, right? Part of the reason you're seeing so much revitalization happen downtown, so much historic renovation going on downtown by JWB and others, is because the incentive packages that developers can get now are higher than what they were 2 years ago, 3 years ago. And the city relied on a lot of influential developers to understand what would be necessary, what would make you want to start actually buying downtown buildings and renovating them. And so we were a part of that process. And that is part of the reason why you have $4 billion of development going on downtown. So these types of innovation wins that we have are game changers, and they play out over decades. And so that's why we're really excited to have an innovation department as a part of our vertically integrated approach.
Love it. Good answer, buddy. All right. Lee's got a couple more questions. So it looks like the community is wise to this. We haven't teased it. Madison shared the actual sheet, the performa, in the chat. But if you are following along at home, you can find it at jwbinventory.com. I'm going to put it on screen here because it adds context to the question. But Lee is asking, maintenance is 7.9%, which sounds a little high from recent homes. Is this due to the fact that the house was built in 2009?
Nothing different. The maintenance is actually 7.5%. So we'll take a look at that here. And that is based on our data of a renovated home. And so it's 7.5%. Maintenance of 7.5% for some who are a little bit new. If you don't know the answer to this one, you should probably go and get the course, because this helps explain it in more detail. So go to notyouraverage.com. But maintenance rate basically means take this percentage and multiply it times the amount of rent that comes in either on a monthly or an annual basis. And that's about how much maintenance cost you should expect on average each year, let's call it. So no difference on this renovated home. The reason why it is a renovated home is it was built in 2009. It's not new construction. New construction would have a lower maintenance percentage, but new construction renovations overall, we love them both because they get you to the same, roughly the same IRR, which is called that 11, 12%, a little bit plus over that.
Yeah, correct. So two things that I want to point out there is, number one, JWB has a different maintenance rate for renovated versus new construction because of that data flywheel, right? Like, these are real numbers. They know the difference between how a house beyond a certain age performs versus a new construction home perform. But at the end of the day, what it's all optimizing for is for the IRR, right? Like, this number is going to end up being the same. The maintenance rate will be a little bit different, but then other numbers over here will be different, right? Like the price to rent ratio will be a little bit different.
Yeah.
Things like that will change in order to get you that same IRR, which, as an investor that wants to be passive, that's what I care about. I want my money working as hard for me as possible, less so everything else. There's another, and this doves perfectly into like the 5 profit centers of rental property investing. And we have, I think it might be BJ, because it's from a Not Your Average Guest here, that says, can you shed some light on year 5 of cash flow? Oh, it's year 5 of cash flow. I thought it was the 5 profit centers. You want to explain the 5 profit centers real quick on how it all kind of comes together when it comes to cash flow and everything else?
Yeah, absolutely. One big mistake, and again, we talk about this in the course as well, but one big mistake of investors, especially rental property investors, is they have cash flow blinders. They only pay attention to one profit center. And, if you're paying attention to one profit center, you're thinking about this like an investment in the stock market. Stock market typically has one profit center, but in rental properties, you have these 5 beautiful profit centers. All you got to do is pay attention to them. Make your decisions based off the 5 beautiful profit centers. The first one is net rental income, or cash flow, which gets a lot of the attention. And we think cash flow is important. It's important to be cash flow positive. It's important to make sure that your investments pay for themselves. However, don't get in love with cash flow, because look at the net benefit of additional cash flow versus if you have to give up other profit centers. Right? So there's net rental income, other profit centers, tax savings, beautiful tax savings you get from owning rental properties. The third one, principal pay down. This is a beautiful situation. I keep saying beautiful because there's no other word to describe it other than a beautiful situation, where when you buy an asset and you take a loan out, you don't pay it back. Somebody else pays it back. As long as you provide a great living situation for them and you treat them well, they're going to pay that loan off for you. That's called principal pay down. Your resident is actually paying your loan down for you. Then you've got home price appreciation. We've heard a lot about home price appreciation over the last few years. It was misunderstood before the last few years, and it was discounted unfairly in the past. People said, oh, I can never count on home price appreciation. Now it's being misunderstood the opposite way, which is people say, a lot of evaluations will have overly inflated home price appreciation expectations going forward. Neither of those is correct, right? If you look at over time, real estate is cyclical. That means that things come back to the norm. Home price appreciation comes back to the norm. So you need to look at it over a 30-year, 40-year run rate to see what the average home price appreciation is for your area. And then assuming you're going to buy and hold for a long period of time, that's what your home price appreciation will most likely be. And that's how we get to 4.6% on our evaluations. So that's home price appreciation. The fifth profit center is inflation hedging and profiting. That is not one that I actually define as far as numerically on your returns. It's just bonus as far as profit for you. Inflation hedging means that, as the price of goods and services goes up over time, which is inflation, the cost of homes also goes up because it costs more money to build a house. And so if you believe that builders are still going to require similar profit margins going forward, and you think that building a house is the way that we're going to create new inventory on the market to meet the demand, then that fundamentally, macro-wise, is why you see home prices go up roughly with the rate of inflation, or a little bit better than that. That's called inflation hedging. And inflation profiting is like really cool. If you buy a property and you use smart debt, it gets easier and easier for you to pay that debt down over time. Another reason why buy and hold makes so much sense. So there are your 5 profit centers.
Are you familiar with what the kids do on the internet? And they put TLDR. Do you know what that means?
Yes.
The too long didn't read. Just FYI, I just figured this out recently. If it says TLDR, someone's just saying, hey, this is a summary. So the TLDR of all of it, which you will get to know if you take the class, right? And like understand it really deeply, is there's the 5 profit centers. People generally overestimate the importance of cash flow. But what we believe here is that most people are doing it wrong. That's why they're average investors. We're not your average investors. We look at this asset class for the beauty of leverage and appreciation over time and the things that that money can do for you once you build that equity. And the key is to have positive or break-even cash flow to keep you in the game with a good experience so that the other profit centers can do their thing over time. And that appreciation at the end of the day, when you look at it, becomes the majority of the wealth creation that's going to happen for you, that's going to change the game for you in your retirement when you need the cash flow, which generally isn't today, it's in the future. Right. So, all right. So now
I was thinking you're just going to stop me soon. That sometimes when I get long-winded and just be like, yo, dude, TLDR.
I'm going to start doing that more often. All right. So then back to the question that sparked this, because I misread it. Can you shed some light on year 5 of cash flow on the conventional finance analysis tab? Seems the cash flow dropped from previous years. I'm
100%
right now.
Yeah, let's do that. Love that. Let's get a little granular here.
Let's get granular.
All right. So this is our conventionally financed tab. If there's a whole lot of numbers here, which is why we typically don't show it, but I'm going to give you the answer here. And I would encourage you to go and download this. We also go through this in depth on the class. So you got a lot of resources beyond the short time that I'm going to explain this here. But year 5, what you'll see is that net cash flow number, right? You see, go to see row 43 there. You see that's your cash inflow and outflow per year, right? So you've got, over $1,000 in year 2, over $1,000 year 3, year 4, year 5, something happens. All right. You got a guess of what happens in year 5?
Yeah. I think we talk about this idea of the average resident stay of 4.5 years. So year 5, you're expected to, the chances are that you're going to have a turn.
Exactly. You're going to have a turn. And when you have a turn, you're going to have a new tenant placement fee. You're also going to have your maintenance and your vacancy cost and things of that nature. That's already included there. But the biggest difference between year 4 and year 5 is row 28. You want to highlight that one there, Pops? All right. Those are your tenant placement fees. So you can see in year 5, you have about $1,800 of a new tenant placement fee. You didn't have one of those since year 1, which was $1,588 in year 1. Why did your tenant placement fee go up from $1,588 to $1,808 by year 5?
Because rent goes up, baby.
Because rent goes up, baby. We like that, right? So that's the biggest reason. And that's why your cash flows are not just flatline when you own a rental property, right? The goal here is for you to have a new tenant placement fee as far off in the future as possible.
Yeah.
And that's why we're so proud of our average duration of resident stay being 4.5 years. It is to your benefit. That is why our vertically integrated team has our goals aligned with you. And quite frankly, most property management companies do not sign 2-year leases and 3-year leases, and they do not renew residents at a rate of 70% like we do. And the reason is because it's hard work and they make less money by doing that. So we actually make less money as a property management company by doing all that extra work, but we make that up because y'all come back and buy more houses with us.
Yeah.
And that's how goals are aligned here. And that's why you'll have a momentary dip in cash flow from year 4 to year 5.
Great explanation. Lee agrees in the chat saying fabulous explanation on the spreadsheet, brother. We got a couple questions on the mortgage rate here, right? So we've got Michael Santorio saying, Greg, according to bankrate.com, the average 30-year fixed mortgage rate on investment rental is about 7.1. You're showing 5.5 on the Excel. Is that a buy down rate? We got Drew Barnhill saying, I see seller concessions on the closing costs. Is this JWB buying down the interest rate that I see listed at 5.5%? And we got Pamela Myers asking, is 5.5% the interest rate current?
Yes.
Tell me more.
Yes, absolutely. You guys nailed it. You got the question and the answer all wrapped up in there. JWB is buying down the rate for our clients because interest rates are higher than we all want. So you see that reflected there in that seller concession. Probably if you go to the little bit to the right there, that box there right above. Yeah, there you go. Right above total initial investment there. So this would be JWB paying down roughly $5,000 to get that lower interest rate for you. And so that 5.5% is real.
Got it. All right. Good eye, community. I love it. Hervé Francois. Hervé, good to have you back in the house, man. He's asking, Greg, Pablo, as more families have been choosing to rent a home versus an apartment, what type of room/amenities have they been requesting, especially as more people are working from home, i.e. a home office, larger den, et cetera?
So the question is, what new amenities are being requested?
Yeah. Has the demand for this type of stuff changed?
Yeah, it has, but our model hasn't shifted, right? Our floor plans haven't shifted. We're not including new amenities. It's because what we have works, right? And there are more people that are requesting more amenities, but there's just a lot more people in the renter space right now because people cannot buy houses at the same rate because of home price affordability issues. It's pushing more demand for workforce housing specifically. And so this type of a home is these 1,490 square feet, 4 beds, 2 baths. You don't have to change the model. You have more demand coming for the model that we serve. And then you also have new demand coming for rentals that have more amenities, new things. We're not there to serve that. We're there to stick to the model that has worked for 17 years. And we just happen to be getting more demand coming there as well. So no changes. I mean, people always request things, but our model is here to serve you. It's here to serve that resident. And that works because we're able to provide a better living situation than the alternatives for that resident. And that's how everybody wins.
Yeah. And I think that the clarification there is this idea that this is the workforce housing type, right? So Hervé is asking overall, most likely in this sector of the economy, there is less options for the people that this is the best that they can afford. And then it also becomes a backup plan for people that are in a slightly higher socioeconomic range and hit on hard times, and then they recede to this thing, right? So like the work from home stuff and all these other trends that are happening maybe in these other sectors of the economy, but this workforce housing sector works really, really well for a long time, and it's really, really resilient, right?
Mm-hmm.
So
Yeah,
kind of it.
Absolutely.
Cool. Got it. Our favorite fee-based financial fiduciary advisor,
Kelly
Barrymom, says not her experience with the interest rate. She just got 6.5% with the buy down. Is this 5.5 a newer thing?
No, Kelly just put her home under contract there. So, there are always differences when it comes to a specific type of loan. So I will never say it's going to work for everybody, but take a lot of that into account. So it goes into play as far as how much you're putting down, right? If you choose to put 20% down, then that roughly $5,000 of cost that we're putting to buying down your rate might not get you all the way to 5.5%. If you look on the evaluation, that is assuming that you're putting 25% down. Okay. There's other things that, of course, everybody's loan situation is different. So what we do is put this together for a typical borrower, certain credit score requirements, certain debt to income requirements. Are you a W-2 employee versus a self-employed individual? Kelly happens to own her own business, so that makes it more difficult for self-employed folks to be able to get the lowest rate possible. It's just the way it is. And the percent down. So I'm not surprised that it doesn't work for everybody, but I feel really confident that the majority of folks who kind of fit that average profile and put 25% down, you're going to be able to get that rate.
Got it. All right. Mark Norman is asking, would you please show where on the map the downtown area is relative to this house? Thank you. Yeah, sure, Mark. We are here on the map. I'm gonna, this is the little green arrow, GC. As we zoom out right here, it is a quick hop and skip to downtown. This is the north core. This is the south core of downtown. This is directly next to it.
There you go.
And most of your properties, right? Like all these properties are, here's downtown, right? It's all surrounding downtown, right? Like one of the kind of things that you guys look at is within a 15-minute drive or so of the urban core.
There you go. It doesn't matter if you're 8 minutes or 10 minutes or 15 minutes. I don't want people to get the impression that you're going to get so much more home price and rent price appreciation if you're like 2 streets closer to downtown than you are. You want to be within 15 minutes. And that's where we're going to put you in these neighborhoods.
Got it. Nora Lerner asked the question. Laura, nice to have you. Yeah, new name.
All right, Nora, thanks so much for asking the question too.
Yeah. It's always, I love when people are new and they ask a question. It's a certain level of bravery. I don't.
The only thing that could be better if she had a nickname too, Nora. If you have a nickname, we would love to hear that.
We would love to hear that too. Nora asks, can you please talk about insurance? We heard many companies do not insure in Florida or are pulling out of Florida.
Yeah, Nora, that's a great question. It's one that comes up pretty often on the show too. We just did a show with Whitney Ritchie, who is the owner of the Ritchie Insurance Group and serves the majority of our clientele in terms of insurance. So you want to look that up either on our YouTube channel or maybe we can look that up and put that in the show notes. You'll be able to get a lot more information than what I'm going to be able to share here. But insurance has been a big deal in the state of Florida over the last year. And on the negative side, it has caused insurance premiums to go up, largely for homes that are older. New construction homes largely have been unaffected. That's why new construction insurance rates are lower on the evaluations, whereas insurance rates for your renovated homes are going to be higher. Think, maybe $500 a year for a renovation home, $500 a year for a new construction home, maybe $1,000 a year for renovations. Did not used to be that big of a disparity. So what has happened is there was a whole lot of lawyers suing insurance companies for things that, didn't need to be sued for. And it caused insurance companies to take massive losses. It caused insurance companies to pull out of the state of Florida at a high rate. It became such an issue that the state of Florida, through special sessions in the legislature, actually came together and stopped roughly 80% of those loopholes that insurance companies were just getting crushed. It is a very bad thing. It was a very bad thing, and it required significant action. On the positive news, that action has been taken, and we feel very good about the long-term prospects. The rate of insurance companies that have been going out of business in Florida is much lower today than what it was 6 months ago. And that's what Whitney told us to expect. The worst of it is over. It will be a longer haul to get our insurance premiums on renovated homes down to the levels that they were before, or even lower than what they are now. But that's what we would hope to happen in the coming years. Regardless, if you make the decision to buy this investment property, you know what your insurance premium is today, because the worst is behind us. And this home has just been quoted by Whitney Ritchie and her team on today's insurance premiums, which are higher, but still get you that 12.9% return on investment there. So you're protected with the decision that you make today. What happened in the past is not fun for anybody. But again, if you bought in the past and you got higher insurance rates, like I have with the 300 properties, I owned those 300 properties through the last 2 years where my home price appreciation was way higher than the extra $500 a year that I'm getting charged because of the insurance issues. So older clients who own the homes, you win. New clients right now, you're winning too, because you know exactly what that insurance rate is going to be, and we're still able to provide over 12% returns.
Good explanation. Madison put the episode in the chat, right? For the Whitney Ritchie episode. Don't be surprised if I am dressed up as Flo from Progressive when you watch that episode, because I always joke around that Whitney is the original Flo from Progressive.
You rock that too. You look so good.
I appreciate that. Now, BJ McKay is asking, so Gregg, are the home inspections still an option to have during the year? And are you seeing any major savings on maintenance repairs for costs?
The home inspections are always an option. I just don't advise it. I mean, I own over 300 rental properties. And so a lot of people will say, oh, listen, I'm going to do an inspection. I'm going to do an inspection. If I saw that doing an inspection actually dropped my maintenance cost or my vacancy cost, I would say it's a great investment for you. I mean, you can do it. I think it's like $50 an inspection or $75 an inspection, but very few JWB clients do. And it's because we actually tested this out on my 300 plus properties. We went over a year and did not do a single inspection on our properties. We compared what the maintenance cost for our portfolio was compared to the rest of the clients that we manage the homes for, where we did those inspections for those homes. And we did not see any difference when it came to the maintenance costs. And so that's why I feel confident telling you that you can do the inspection if you want. We'll provide for it, but I don't do it on my own homes. I don't see a lot of value for you to spend that money to do it. So there you go.
There you go. All right. Last question. Leo Farragana.
Dun, 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 dun.
Farragana.
Dun, 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 dun.
Yes. Buying down the rate by JWB. That's great. I'm not sure if other turnkey companies are doing this. For how long do you guys think you'll be doing this? Also, shout out to my ex-colleague, Joe Kazoon, who is listening to the show right now.
All right, Joe. Nice to have you as well. Yeah, it's not often that we would do something like this, but it's also not often that the Fed would raise the federal funds rate, 10 times in the last, year as well. So these are just unusual times when it comes to interest rates, and the shock of the interest rates going up so quickly is something that we wanted to do something for. So I have no timeline on how long we are going to do this. It's something that we talk about on a monthly basis. It's something that we're doing right now. I don't know how long it's going to last.
All right, cool. And I want to close out the show with Lee put this in the beginning. He puts, I'm losing my portfolio manager, Helen Duque, on, I hope I'm pronouncing that correctly.
Mm-hmm. Yeah.
All right, cool. On Friday. She is continuing her education, and I wish her continued success in her future. Our friend Helen will be missed by both Jane and I.
Our clients really get to be close with our team. And Helen is an incredible asset to JWB. We really wish her well in her future endeavors. And, but that special relationship that we get to have when we get the opportunity to serve a family like Lee and his wife, Jane, and understand what we're working towards and to have that shared success, it's something that's really moving for our team. And I know for Lee it is as well. So, we'll continue to attract talent just like Helen, and continue to maintain that very high standard that she has for you, Lee. And we wish Helen the best.
Yeah, a bunch of people are checking in here that they're going to miss Helen. That's really cool. I love that. No show on Tuesday because there's something happening.
4th of July, baby.
4th of July, America's happy birthday. So no show on Tuesday. We'll be back the following Thursday. POT Dubs, 70 plus people, GC.
I love that.
Man,
high five, everybody.
Tons of great questions. 70 plus people on that Thursday, middle of the workday, never goes unnoticed. Thank you so much for making time to be here. We never take that lightly. And the amount of questions and the amount of great insights that come from our community is really what makes this thing special. So I just want to express a deep sense of gratitude to all of you that showed up today. Really awesome stuff. Do you see?
I think it's incredible. I also wanted to highlight Leo, who invited his friend. If you talk about the people who are showing up here, guys, we don't pay money to sponsor, to advertise this show anywhere. All of this growth that we've seen in the last few weeks, going from 45, 55, 65, 75. We even had over 100 folks that have attended shows recently. That's because of you guys. It's telling your friends and your family. So Leo, thank you for inviting your friend. I think it was Joe. It's really nice to have you, Joe, on the show. And I would encourage all of you, if you feel like this show is a positive influence on your life, and you know somebody that would also be positively influenced, please let them know. Right. You can go to nyais.com. They can register, join the live audience, and the party can keep getting bigger and better with the right people. That's what we want.
With the right people. And you know what makes them right is when they are not average. We'll see you all next Thursday. Happy 4th of July.
Bye.